Hello and welcome again. I just took a break to drink some water. Let's resume our lecture then. In the previous lecture we finished till here, which is taxable income. Now taxable income is the income on which we have to pay tax. That is why it is called taxable income. Now how can we pay the tax? Please open up your notes now. I won't share the screen with you in this lecture. Just look at your notes which you can find on our website. If you check your notes on page 1 and the pro forma is given to you in the exact form like I have written on the whiteboard. Although on the detailed section, if you look at me now here, on the detailed section I've put the trading income, then property income and pension income. Now the order by which I have given on the board might be different from the one which is given in the notes. Obviously the notes are made by myself as well, but what I mean to say is that there isn't any specific order by which you can write the income. Say for example, you can write down the employment income first if you want, or whichever income, say for example dividend income first. So there is no specific order. Having said that, now look at your notes. After all the income where it says taxable income, where it says less personal allowance, and after that it says note 3 as well. Now after personal allowance it has given you different tax rates, tax bands. So what are the tax bands? After deducting the personal allowance, obviously it will be our taxable income. Now how can we calculate the tax? The tax table is given, which it says taxable income starting rate band. Now the income will be taxable according to different banding. Excuse me. Now what are the banding rules? From £1 to £5,000, if your income is from £1 to £5,000, non-savings rate is 20%, savings rate is 0%, and dividend 0% as well. For basic rate band, it is from £5,001 to £32,000. So basic rate band is 20% for non-savings and savings, and 7.5% for dividends. Now these are different rates than the ones which you might have seen earlier if you are giving it for the second time, because this is our different Finance Act, which is Finance Act 2016. Our higher rate band starts from £32,000 in one to £150,000. Now in the brackets which I've given, £118,000. This is the difference between £150,000 and £32,000. Now you need this difference when you are doing a very comprehensive questions. So just to save our time, I've given the total. And in the higher rate band, the tax will be non-savings and savings 40% and 32.5% in the dividends. Likewise, in the additional rate band, which is above £150,000, 45% for non-savings and savings, and 3,800.1 for dividends. Now, after calculating the tax according to this table, now just close your notes for now. After calculating tax according to the table given to you in the notes, now this table will be given to you in the exam as well. That is the good news. The tax table will be given to you in the exam in the exact form which you have just seen here. Alright, so that is our taxable income, and we have to calculate the tax according to the tax table given to you in your notes and in your exam. Now assuming that we are calculating the tax liability, and say for example if Mr. A's tax liability is, I'm just making up the figure, it's £10,000 if I say. So if liability is £10,000, or which is £10,000, make it £10,000. So if his tax liability is £10,000, say for example, now we have to reduce this tax liability by these tax reducers. Now these are known as tax reducers. Why these are known as tax reducers? Because these are the things which reduces the tax liability. That's why these are known as tax reducers. Now first tax reducer is investment in VCT. Now these are three investment companies in which you buy the shares. So if you buy the shares in VCT, which is Venture Capital Trust, Enterprise Investment Scheme, and Seed Enterprise Investment Scheme. Now if you buy the shares in one of these three companies, and if you fulfill some of the conditions, then what you get is 30% tax reducer in VCT, 30% in EIS, and 50% in SEIs. We will look at these schemes in our couple of lectures because it is very, very important from exam point of view. But for now, just assume that, say for example, if you have invested £10,000 or £1,000, say for example, if you have invested £1,000 in VCT, you will get 30% of £1,000. That will reduce our tax liability here. If you have invested £1,000 in EIS as well, and you will take 30% of £1,000, and it will also reduce our tax liability. Likewise, 50% tax reducer in seed enterprise investment scheme, and that will also reduce our tax liability. Apart from this scheme, apart from these investment companies, if you invest in these, you will get the tax reducer. Another tax reducer is which is marriage allowance. Now, marriage allowance is an allowance. Say, for example, if you are a married couple or you are in the civil partnership within the UK. Civil partnership is simply when you are in the same gender, you are in the same you are same sex and you are married couple, or you are living as if you are married. So that is if you are in the civil partnership or if you are in a married relationship, then what you do is, if one of the spouse is earning too much money and the other spouse is not earning any money at all, then what the person who is not earning any money, they can transfer some of their personal allowance to the other person who is earning much money. All right, just to pay less tax. Say for example, if I am earning £30,000 and my wife is not earning, my wife is not working at all. So if I'm earning £30,000 and my wife isn't earning anything, so I'm paying some tax, because I'm earning more than £11,000. So what my wife can do is she can transfer some of her personal allowance to me so that I can pay less tax. So what she can transfer is, she can only transfer 10% of her basic personal allowance. What is personal allowance? £11,000, isn't it? So 10% of £11,000 is £1,100. So she can transfer £1,100 to my personal allowance. So what that transferable personal allowance, which is marriage allowance as well, it is the same thing, sometimes known as marriage allowance. What she did is she transferred £1,100 to myself, but that £1,100 will not be added in my personal allowance. What her personal allowance will do, her personal allowance will reduce my tax liability. That's what happened here in the case of Mr. Z. Now, Mr. Z's wife has transferred her personal allowance, and when she transferred her personal allowance, it was £1,100, and you will get Mr. Z will get 20% tax reducer on that, and that will also reduce his tax liability. Now, this will only be given if Mr. Z is a basic rate taxpayer. If he is not, most likely, if we look at the sources of income he has, he will not be basic rate taxpayer. But we are giving, we will only apply the marriage allowance if he is a basic rate taxpayer. All right. So he will get 20% tax relief on the allowance which is transferred to him by his wife, and that will be 20% of £1,100. All right. And after that, if we deduct all of these, then what we need to do is we have to deduct the tax deducted at source as well. And what is tax deducted at source is that this is the tax which has already been deducted while paying us the money. So for example, if I work for Accountancy Tube, they pay me salary and they pay me pay slip as well. Well, now when I check my pay slip, what I've got is gross amount, gross salary, then I have got some deductions, and after that what I got is net salary or net pay. Now these deductions are pay, these deductions are deducted at source. So what I do is, while making up the pro forma, I will write down the employment income and I will write down the gross amount here. But what I do here is, I will deduct what has been deducted out of my salary. So that is pay, P-A-Y, pay as you earn. Now that will be deducted here. Likewise, if any other tax has been deducted, interest on loan stock is also been deducted. Now interest on loan stock is interest which I told you here, that is our interest income which is always paid gross, except for one source of income. If I pay interest on the loan stock of an unquoted company, that interest will be paid net. Now if it is paid net, then we need to gross it up. Now if it is paid net, it means the tax has already been deducted. So what we do here is, if it is interest on the loan stock of an unquoted company, we take the gross amount and we take the 20% of that, and we will deduct that as well. That will be tax deducted at source as well. Likewise, if you talk about that discretionary trust, here you go, income from discretionary trust, 45% of the tax has already been deducted. What we do is we take the gross amount of income from this discretionary trust and we will multiply it by 45%. So we'll take the 45% of that. That will also be tax deducted at source. Another thing is that income from gross income from interest in possession trust. Here you go, 20% interest has already been deducted here. So that what we do is we take the gross amount and we take the 20% of that. That will also be deducted. So this is the total of tax deducted at source. So we'll deduct all of this, and that will be our either income tax payable or it will be receivable if we have overpaid it. All right. So either it will be an income tax payable or receivable. Now there are, if you want to note down this stuff, I'll just move on one side. Please make sure you just pause the video and note down everything I've written on the board. I hope that you have already noted it down. Now there are two reasons why I asked you to note it down. This thing is already given to you in the notes anyway. But the reason I asked you to note it down is when you write down with your own hands, it will be more effective than you just read, right? So that's why I asked you to note down. Another thing was, if you remember, if you just check your notes, that interest income is given to you here. And in the notes, it will only say that interest income is always received gross. Whereas, I didn't mention in the notes that there is one source of income, which is when I pay interest, when I receive the interest on the loan stock of an unquoted company, then it will be received net. Now, this thing is not mentioned in the notes. So that's why you need to watch the lectures and you need to write down the things which I tell you in the lectures. Another thing which is not mentioned in the notes is this thing, marriage allowance, 20%, 1100, 20% of 1100 marriage allowance, which is a tax reducer as well. This is not mentioned in the pro forma which is given to you in the notes. All right, and apart from that, I think everything is mentioned in the notes. So please make sure you write down everything I've listed on the board. All right. So that was our income tax pro forma. That's it for now, and in the next video we will look at some of these bits and pieces which are mentioned in the income tax pro forma, especially if you look at interest income and dividends income. Now, the previous treatment of interest and dividend income was a little bit different than it is now. Previously what we need to do was we need to gross it up, gross up the interest income and dividend income as well, obviously with different rates. But what we now need to do is we do not have to gross up interest income and dividend income. Now there are some of the complex issues as well which are with interest income and dividend income. Excuse me. We will see them complex issues in the next video. All right. Thank you very much, and I will see you in the next video. Thank you and goodbye.